Well, hi and welcome. My name is Casey Boland, and I'm a wealth advisor with HCM Wealth Advisors. I'm joined today by Doug Johnson, who's our Senior Investment Strategist, and Dan Rinck, who's a Research Analyst with HCM Wealth Advisors. Welcome to our webinar. If you'd like to ask a question, please go to the bottom of your screen and click on Q&A, and there you'll have an opportunity to submit your question, and we'll do our best to answer at the end of our webinar. So guys, it was a rough day here in the market. You know, the Fed came out with their decision today, and to no surprise, interest rates, they're going up again another 3/4 point. And unfortunately, I think some people had the expectation that they were going to hope that the Fed was going to look to tap the brakes. And unfortunately, the market seemed to go down, Doug, with that news.
Yeah, Casey, I didn't mean to sync the title of the last song, Sympathy for the Devil, up, but I don't think people have a whole lot of sympathy for Jerome Powell at the moment, but we'll see how that goes.
Yeah, and I think if people have an expectation that the Fed is going to hit the brakes right now anytime soon, I think until they start to see definitive data that inflation really is slowing down, and that's really, I think, what they're going to have to see before they're going to start to slow down or even hint that they're going to slow down. So I think we need to pump the brake on expectations at the hope that the Fed's going to change course otherwise. But we'd like to start with the positive focus. And so let me shift a little bit. And from a positive focus standpoint, I want to steal Dan or Doug's thunder, but we're going to get to talk about the month of October. And history normally has been people are scared about the month of October, but actually there's a smile with the month of October. So I'll let these two be more involved in that discussion a little bit later. But November or October actually gave people a little bit more hope and something to smile about in opening statement. So we'll talk about that a little bit more here in a bit. All right, so moving on, though, we've got a lot to cover today. So I'm going to start working and covering some data related to the economy. So let's review some of these macro data cross currents. They never provide a clear picture, but they can provide evidence as to the direction of the economy. So the first one we're looking at is called the S&P Global Flash. Flash, we'll tell you why the word flash here in a second. U.S. PMI Composite Output Index. So what it is, it's the PMI stands for Purchasing Managers Index. It's based on a survey data of about 800 companies in the manufacturing and services sector. And they call it Flash because it's not the final report, but it represents about 85% of the respondents. So you're essentially getting some advanced data until they have the final print. And unfortunately, though, with this data right now, it's signaling contraction in the economic activity in October. So from the report says, U.S. economic downturn gathered significant momentum in October, while confidence in the outlook also deteriorated sharply. The decline was led by a downward lurch in services activity, fueled by the rising cost of living and tightening financial conditions. While output in manufacturing remains more resilient for now, October saw a steep drop in demand for goods, meaning current output is only being maintained by firms eating to backlogs at previously placed orders. So clearly, right now, this is unsustainable absent of a revival in demand. So it's no surprise to see firms cutting back sharply on their input buying to prepare for lower output in the coming months. So moving on, we're going to talk about the housing market, and no surprise there. When you look at new residential sales, those have been starting to slow. The pace of new home sales in September fell about 11% from months prior. And in addition, home prices are cooling. According to the S&P CoreLogic Case-Shiller Index, home prices fell in August, which is the second consecutive month of declines. So I think this is, well, it's you don't want to see necessarily a lot of slowness in the housing market. I think people get flashbacks to 2008, 2009. That's not the environment that we're involved in, but certainly housing was not sustainable. And that's going to be one element that may slow the consumer down potentially a bit. So moving on, we look at the cost of borrowing. Mortgage rates, according to Freddie Mac, the average rate now is over 7%. It's the highest level now since April 2002. And that's leading to greater stagnation in the housing market. With inflation enduring, you've got consumers are seeing high costs now at every turn. causing further declines in consumer confidence now each month. So many home buyers, they're choosing to wait and see where the housing market's going to end up, pushing demand and home prices further downward. What's the impact of an interest rate movement? Earlier in the year, the 30-year mortgage was right around 3.5%. Now it's 7%. So for a $250,000 loan, the payment on a $250,000 at 3.5% was a little over $1,100 per month. And at a 7% loan, the mortgage payment jumps by $540. It's over $660. So you're talking close to a 50% increase in your mortgage payment. You add all that housing data together, it's taking a toll on the economy. According to the third quarter GDP report, which is a report measuring economic output, essentially was a 1.4 percentage point drop in peeling off GDP growth, unfortunately. All right, let's look at some bright spots. So supply chains are greatly improving, and the pressures have eased so much that we may start to even think about retiring the idea that it's really even a crisis anymore at this point in time. Supplier delivery times, it's one of the more intuitive manifestations of supply chain constraints. They've dramatically increased from levels from a year ago. And according to the S&P Global Flash US Composite PMI, in their report recently, the incidence of delays are now at the lowest level since July 2020. And activity suggests then by regional Federal Reserve banks, they look at a lot of trends and composites. And for them, their delivery times are collapsing to their lowest level since 2009. So you're seeing great improvements there. You look at specifics, you look at trucking rates. So we move on to the next slide. Trucking rates have come down dramatically. You pair that down with seaborne containers, those have dropped substantial amount as well. The backlog of ships outside the port of LA, Long Beach, back in January, you had 100 ships out in the ocean, and pretty much that backlog has completely cleared out. And with global progress on vaccinations, we expect supply bottlenecks to normalize even further. So some of the improvement in delivery times to freight costs, they can be explained by slowing demand in the cooling economy, but the point is that demand and supply are getting more in line. And that said, demand hasn't exactly fallen apart though. So I think a lot of people are still asking, is a recession in the cards? When you look at leading economic indicators, and that's what the LEI is on this chart, it certainly indicates contraction. And we're getting closer to the levels often associated with recession, represented by the dotted yellow line. So what goes into the LEI, the leading economic indicators? Well, if we go to the next slide, you can see there's 10 components listed on the left side of the slide. And we've got what we call the current level and what's the trend of those different indicators. And the level has a picture indicating one area of strength, which is unemployment claims, which is tied to the labor market, and with a few areas at fair, but the majority you see they're indicating weakness. Now the trend column, that shows the outlook, and which doesn't appear indicating a very rosy picture, because in all cases where the level is weak, instead of seeing the words improving, we're seeing worsening. So the expectation is that the economy will continue to deteriorate, but what seems to be ignoring the signs of weakness. Let's take a look at the next slide here, Doug. So what's ignoring it? It seems to be consumer spending and employment. Here's the message you have from the chairman and CEO of American Express, with the message that spending remained at near record levels this past quarter. It seems like anywhere you go, it doesn't feel like a recession out there with all the spending that you see, whether it's in restaurants, anywhere you go, still people are out and about spending. And despite the inflation increases, the consumer seems to be absorbing many of the increases. It continues to spend. Now, in some ways, that high spending, it's helped keep inflation high as well. And I mentioned employment. Employment, when you look at the next slide, employment right now, unemployment rate is below 4%. And that's not anywhere close to recessionary numbers. And the job market has stayed extremely strong. And job openings, they're coming down as indicated by the blue line on this chart, but there are still nearly 2 job openings per unemployed person. The labor market strong, a strong labor market keeps wages higher, which keeps inflation high. that's something that has to give at some point in time. That's, I think, what the Fed is keeping their eye on. We're hearing from a lot of organizations and reading about it that you hear something called labor hoarding. And I think a lot of organizations are seeing on the other side of this cycle that they need employees. And you keep hearing stories about how difficult it is to find people. So right now, I think a lot of organizations have been apt to keep people on staff, knowing they can get through this cycle. The consumer is in pretty good position. Businesses are in pretty good position. If they can get through that, navigate this, then on the other side, then they're in a better position on the rebound. But at the same time, right now, the Fed is looking for weakness. And right now, you're just not seeing a whole lot of that. And I don't know if you're going to need to see a lot of job destruction to get there. Certainly, you're going to see it on the demand on the housing side, and that's having an impact. But we're going to have to see how things continue to play out. Dan, I'm going to hand it off to you.
No, you're actually going to hand it off to me, Case.
Oh, my apology, Doug.
No, so the whole discussion around the Fed, which I think it's amplified today with the fact that they just raised 75 basis points about 2 hours ago. Casey talked about employment here, and we can see that obviously the Fed would want to see a tighter labor market before they can quote unquote claim victory. But I think one of the concerns is that, do they push conditions too tight to the point where they do tip us into recession? I think that's kind of the battle that's going on right now. But it's also taken its toll in the fixed income market. So this slide is titled Unprecedentedly Unprecedented. I'm not even sure that unprecedentedly is a word, but it sounded good when we were putting this together. So I left it on here, but you can see for the Bloomberg US Ag, which is basically the S&P 500 for bonds. This goes back to 1976. And this chart shows both the intra-year declines, the peak intra-year declines, and then what the index actually returned over the course of the year. So for instance, if we look at where my laser pointer is right now, the largest decline that we had during that year, which looks like it was either 1979 or 1980, was 9%. And then the index ended up being 3% this year. So if you take a quick glance at this chart, I think your initial takeaway would be bonds are positive in most years. And even when they're negative, it's only a small amount. Well, then you come to 2022 and you see this absolute outlier of a reading right now. And, this loss in the Bloomberg US Ag is a direct result of the Fed's desire to raise rates and try to stamp out inflation. Now, I think a lot of people expected rates to be raised during this year, but I think what caught a lot of people off guard was the velocity of the rate hikes. Remember, you had Chair Powell, I believe it was in June of this year, saying that they didn't believe 75 basis points was going to be necessary. Well, they've just raised 4 times in a row at 75 basis points. So the data is certainly changing quickly. Now, with a loss in bonds of 15% this year, where does that leave us going forward? Because we have to remember that bonds are basically math problems. And some of those math problems are longer than others in terms of how long a bond has to maturity. But at the end of the day, we know that bonds will mature at par. And with a loss like this, it's put us in a situation where there could be some opportunities that are starting to pop up in the bond market. So one chart to kind of show the extremes that we're seeing right now. So this goes back to 1977 and it shows every down year in the S&P 500 from a total return basis since that point. So we've had eight references to that. So 77, 81, 90, 2000, 01, 2002, 2008, 2018, and then year to date. It also shows what that Bloomberg US index did on a total return basis. So what you'll see is every year that we've had a negative return on stocks since the 70s, bonds have returned a positive number. 2018 maybe an exception that was flat, but usually you get some protection from that fixed income side. Whereas this year you are not getting any protection at all, at least so far. So for investors who have been historically in a mix of equities and fixed income, that fixed income has provided some kind of cushion. This year, that just has not existed. So where does that leave us going forward? So this chart shows what the returns would be for different classes of bonds if you saw both a 1% increase in interest rates or a 1% drop in interest rates from the current levels. Now, what you'll notice here is that most of the return profiles actually reside on the positive side here. And part of the reason for that is, one, this is a total return chart. So you have to remember the starting point for a lot of these treasury assets, 2, 5, 10 year, the income component of that is now jumped to 4.5%. So the tailwind that you're getting from the income portion of these investments has risen substantially. And then just as a reminder, if you see a 1% drop in the level of interest rates, bond prices are going to move in the opposite direction. And based on what kind of rate sensitivity you have in the bond, it could be a big move up or it could be a small move up. So this chart highlights the 30-year US Treasury, which has had an absolute disaster of a year. 30-year US Treasuries have the highest interest rate sensitivity that you can find. But if you look here, the benefit from seeing a 1% decrease in interest rates is almost twice as much now as would be a 1% increase in rates. And then as we move on down the line, you have things like investment grade corporates, high yield, municipals, leverage loans. Some of these things actually have positive payout over both rate hikes and rate falls. And I think a lot of that has to do with the fact that a lot of the worst in terms of rate hikes is probably behind us. Yes, there could certainly be some additional incremental hikes as the Fed continues to fight inflation. But I think as investors probably, understandably have kind of shunned fixed income after what's happened over the past 10 months, we really think that there is opportunities presenting themselves right now for clients who need to generate levels of income. And we think the risk return profiles are starting to look much, much better than they did 9 to 12 months ago. So where are rates right now? And again, this was before the Fed meeting this afternoon, but as I glanced at the numbers before I hopped on here, they didn't change a whole lot, surprisingly. So you have the 2-year yield right around 4.5%. You have the 10-year yield right at around 4.1. And as you can see, as early as the beginning of this year, the 2-year Treasury was right around 75 basis points. And at the beginning of 2021, even the middle of 2021, it was sitting right around that flat line. So an absolutely astronomical rise in the 2-year yield following what the Fed has tried to do. But the most important line on this, I think, is the 5-year inflation expectation from the market. So if you look, the market expectations of inflation going out 5 years is only 2.37%. So if we looked at CPI right now on an annual basis, that number is closer to 7.5 or 8. So the market expects that inflation will get back down into the 2s, the mid 2 levels over the next 5 years. Now, whether or not that's going to be a straight drop from what we've seen here and just kind of going sideways, or that's going to be a gradual decrease. If you look at the levels that bonds are at right now, the ability to quote unquote lock in yields at today's rates with the expectation that inflation will be under that in the future is a very good and powerful thing. We talk a lot about, or you hear a lot about real yields. So real yield just is the nominal yield rate or whatever the current market rate is minus the inflation rate. And when you have negative real yields, that is a bad thing. But when you have positive real yields, that can be a good thing for people who are looking to generate income and not have the bite of inflation cutting into that so much. Now, what has been the history long-term of 10-year Treasury rates? Because, we're hearing a lot of very, interesting forecasts for how high rates can actually go. We talked about in the last webinar the fact that the Fed has always gotten the Fed funds rate above the rate of inflation every time we've had a significant spike in inflation. And if inflation's running at 7 or 8% right now, that would imply that the Fed's job's only halfway done, which I don't think the Fed has any intention of getting the Fed funds rate in the 6, 7, or 8% range. But what would that mean for other treasury yields? And I'm sure there would be a knock-on effect to equities here. But this chart goes back to 1790. It's not very often you find charts that go back this far. And there's a lot of annotations on here. We're not necessarily worried about that. It's more of this line and the levels that it's kind of bounced around at. So if you go back, almost to the 1800s here, here's the 4% level, which is kind of where we're at right now. And if you were to draw a line right through this, my guess would be that the average of all of these would be right around that 4% level. So I think historically, going back as far as we can, rates are still low if we look back 30 or 40 years, because we have this giant spike because of inflation. But historically, you're right around the level of normal yields. So do yields have to go higher? They don't have to, and much of that will be dictated by inflation. But they're right now sitting at what I would call kind of normal levels. One interesting thing to point out here is that you can see this dotted line. And here's the Federal Reserve System created in 1913. And if you looked at pre-Fed versus post-Fed, ironically, I would say that the Federal Reserve was created to what creates price stability and maximum employment. There looks to be a little bit more price stability on this side than there does on this side, but that's the last Fed jab I'm going to have for today. I promise. So where is inflation leading us at this point? If we assume that inflation is simply a monetary phenomenon, and there's definitely some debate about that right now, we would expect inflation to continue to roll over, and it could, in fact, be pretty dramatic. So this is M2, which is the money supply, year-over-year change led by 16 months. So we can see that there's been a pretty substantial decrease in the percentage change in M2 year over year. We would expect inflation to continue to follow that path again, if inflation turns out to be simply a monetary phenomenon. Now, we've talked a lot about supply chain issues, and does this inflation problem pretend more to the supply side than it does to this demand side? Because again, the Fed's raising rates simply to attempt to squash demand. But if there's still limited supplies of oil, gas, wheat, food, whatever commodity you want to choose, the Fed has no ability to print hard assets. So they are trying to take away a demand problem. And if it turns out that there's supply issues that are causing this, then their rate hikes could cause more problems than they do solutions. So we're hoping that that's not the case. And we do expect inflation to continue to work itself lower over the next few months. Now, what does inflation do to earnings? Inflation certainly is going to hurt margins. So, labor costs, input costs, anything that has to do with a company producing its good is going to have a negative effect on what ultimately profit margins are going to be, which is ultimately going to have a knock-on effect on what earnings are going to be. So this is the percentage of S&P companies with an increase or decrease in their net profit margin going back to Q3 of last year versus what it is this year. And you can see for most of these sectors of the S&P outside of energy and industrials, you can see that more than 50% of these sectors, or the companies in these sectors, I should say, are seeing a decrease in net profit margins. Now, has that had a knock-on effect on earnings yet? It doesn't appear that way. Now, again, this is earnings that are above inline or below estimates. And we've talked a little bit before about the Wall Street game of the estimates start really high, then they come down, they come down, they come down, they come down, right up until the day they're reported. And then all of a sudden you have beats on estimates that have been revised lower substantially. So this is taken with a little bit of grain of salt, but the good news is you're seeing a lot more green on this chart, which shows that earnings are continuing to come in over estimates. But at some point, as those profit margins continue to shrink, one, the estimates are going to either have to come down or the earnings are going to have to come down. And ultimately, the level of the market is going to be determined by what kind of earnings levels can be generated by companies in the S&P 500 and in other indexes as well. So where does that lead us in terms of valuations? We've talked about the valuation picture before. This is the trailing 12-month PE ratio going back 10 years on the S&P 500. So during the COVID spike, we had a dramatic increase in trailing 12-month PEs, and that was a combination of prices shooting higher, but also you have to remember there was almost no earnings during COVID. So you have the denominator being the price going way up, or I'm sorry, the numerator and the price going way up and the denominator and the earnings going way down. So it's natural to see a spike up like this. But since then, the combination of the opposite effect, lower prices, and we'll call them stable earnings, have pulled valuations back down. And now we're sitting on a trailing 12-month basis, lower than both the 10-year and the 5-year average, right around 18.5, 19 times. So not necessarily ultra cheap by any means, but concerns about valuations being ultra rich, I think are getting a little bit better by the day. Now, if we take the median price to earnings ratio across the board, and again, the median is just kind of in the middle, it paints a little bit of a different picture. So really focusing on the two graphs here in the middle, you have median price to earnings ratio going back to the 60s with a linear regression line. So basically just the average line through this, and anything above that line would denote an expensive market, anything below it would be cheap. And right now we can see that that line has moved below that regression into the cheap side. And then if we see the percentage above or below that trend line, again, we see this number starting to creep down into the undervalued area. So it begs the question, kind of, how do we see a general market valuation that looks to be quote unquote fairly valued, but then when we take the median price to earnings ratio, the market looks to be a little cheaper. And Dan, I think 18 months ago, you couldn't have a conversation with an equity investor about them asking about whether or not they owned Facebook, Amazon, Apple, Microsoft, or Google. And that certainly created an interesting dynamic in the way that the market cap turned up. But I'm curious to see if those same questions are being asked right now.
Yeah, absolutely. I know you didn't want to talk about the Fed anymore, but coming out of 2020 and 2021, in the liquidity-rich environment, you saw everyone flocking to the FANG stocks. And this chart right here shows the top 5 stocks, mainly FANG stocks: Facebook, Google, Apple, Amazon, Microsoft, as a percentage of the S&P 500 market cap. And as you can see right now, it's sitting at 21. So it used to be you would take a look at those top 5 stocks and you would have a pretty good idea of what the market was doing that day just because they had so much influence. And you're starting to see that number fall. It was around 24. Now it's heading down to 21. And we're starting to see a little bit of a shift under the surface with the S&P 500. So over the last couple of weeks, you had the big tech earnings, and this chart shows Alphabet, Microsoft, Meta, which was formerly Facebook, and Amazon, their performance over the last couple of weeks. So as you can see, it was a really tough time for those big tech companies. Microsoft down 7, Alphabet down 11, Amazon down 19, and Facebook down 26. But if you look, the S&P 500 didn't really falter, even though 20% of its market cap was having a terrible, terrible time. And the same can be said for year to date. If you were going in and looking at those FANG stocks and really chasing those high performance numbers, 2020 was a little bit of a reality check. So as you can see, S&P 500 has been hit pretty hard this year, down 18%. But if you look at some of the components, Microsoft, Facebook, Amazon, they're down much larger. Facebook down very, 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 very bad. So you can see that the S&P 500 is definitely holding up and kind of starting to deviate from some of those big name FANG stocks. And again, we talked about valuations earlier, and if you look at S&P 500 PE ratios and strip out the FANG stocks, they look even more attractive. So remember, Doug, we were seeing, the median around 20, and then trailing PEs around 18. Well, if you take out those FANG stocks, Apple, Amazon, Microsoft, Facebook, Google, we're looking at around 12. So, we're no longer in the fairly valued camp. We're starting to look pretty cheap if we strip out those names and start looking at other parts of the index. And another part of the market, which we are really paying attention to and starting to get eyeballs, is small caps. If we think the S&P 500 is starting to look attractively valued, small caps are looking very, very cheap. So right now you're seeing a PEs around 11, and we bought a little bit of small cap back in June, and it's definitely going to be on our radar, because on the next slide. So if we are in recession, or if you believe that we entered recession earlier this year, when there was the technical recession, when those 2 quarters of negative GDP growth, it is a very interesting time to look at small caps. So this chart is a composite of all small cap returns coming out of recessions compared to the S&P 500. So the S&P 500 is that gray line, and the dark blue line is small caps. So if we are truly leaving that recession, then small caps would be a good place to look. But at the same time, we also have to be very cautious, because small caps are very reactive to economic developments, and we really don't want to be early into small caps. So it's definitely something we're going to be looking closely at. We're not quite looking at loading the boat with small caps, but it's definitely something that we'll be keeping on our radar.
So Casey made it alluded to this earlier, but we talked about spooky October. So obviously with Halloween, but here are newspaper headlines from 2 of the biggest single day market crashes in history. So on the left, you've got the Brooklyn Daily Eagle, which I'm sure is a paper that's not around anymore. But Wall Street in panic as stocks crash. So this is from Black Monday and Black Tuesday from 1929. You had a 1-day change of negative 12.8, followed by a 1-day change of negative 11.73, which comes out to be close to 23-24% when you compound it. And then the one on the right is obviously the crash of 1987, which we had a single day drop of 22.6%. So seeing these 2 things and being human beings and drawing conclusions, what is the conclusion that we can take away from what October means for market returns?
I think certainly we are all shaped by history, and we tend to focus on and remember these bad times. And so it's very easy for somebody to probably answer, Doug, that October by far is always the worst, but in fact it is not. So Doug, what is the worst month typically?
Thank you. I know that was a setup question, but I was waiting for somebody to actually step into it. So here's the seasonality chart. Dan, why don't you go ahead and go through this for us?
Yeah, absolutely. So this chart essentially shows returns of the S&P 500 by month. In yellow is since 1950. In blue is in the past 20 years. Green is the last 10 years. And dark blue is midterm years, which we're in right now. And as you can see, October is not a very scary month at all, no matter what Casey says. And you really are starting to see those those last 3 months of the year, some really strong market gains, a Santa Claus rally. So over the past 10 years, even though we've had a great October, November has actually been very strong as an aggregate and very strong during midterm years. So you can really expect to see hopefully some strong market gains in the month of November. And again, here it is, the last month, the trailing equity returns over the last in all of October. So at the very top, you have value. You have our high dividend ETF, HDV, and then you even have small caps in there. So again, this is kind of going back to that first slide where the S&P 500 is starting to disconnect a little bit from those high flying tech stocks. And you're starting to see the value stocks, you're starting to see defensive stocks, you're starting to see small cap stocks really taking the lead. And again, the S&P 500 for the month of October was up 7.23. And then year to date, again, you're starting to see a little bit of that deviation. Everyone was talking about the Dow last month. Dow was pretty heavily on the industrial side, heavily value side. So HDV, our high dividend ETF, is actually up year to date. And then you're seeing the value factor ETF and the small cap ETF all outperform the S&P 500. So you're starting to see other pockets of the market really providing excess returns, where it used to just be large cap was the only place to be, and now there's opportunities. And then so 2022, it's been a very historic year. You've had Russia invading Ukraine, you've had historically high inflation, you've had the Fed tightening at one of the faster paces we've seen in a very, very long time. And it's also a midterm year. So midterm years are typically some of the most difficult for the market in the presidential cycle. So this chart shows an aggregate of all midterm years in the blue, and then the current year right now in red. So as you can see, there's other factors that are leading to stock market troubles in 2022, but typically a midterm year is pretty challenging in general. And then as you can see, the pre-election cycle and the election cycle are always very strong for the markets. So if we do find this soft landing that the Fed is trying to achieve, we could be set up for some really good returns going forward on the equity side. And then again, this chart essentially shows every single midterm year, the performance a year out. So one thing that is a really big positive is the aggregate line is the dark line in the middle, but every single midterm year, the next 12 months, the market was positive. So again, it's been a historic year, and I would not like to, make history again on this chart, but history is telling us right now that things are going to get better once we get past these midterms. And a year out, we could potentially be looking at positive equity returns.
So to wrap all that up, kind of where does that leave our base case here? So some questions. Can the market rally into year ends? We just talked about seasonality. Sentiment remains pretty negative on the most part. So if you look at that as a contrarian indicator, that certainly could provide some fuel to see a rally into year end. So seasonality and sentiment would say yes. I would say macro headwinds are saying prove it. So we're cautiously optimistic that we could see that rally into the year end. But we also recognize that there are significant macro headwinds going into year end. So is the Fed closer to slowing their projections on rate hikes? I would say possibly. After today's conference and rate decision, you had some mixed messages on what they were actually projecting going forward. I think at one point Powell said that they were a little bit concerned about the lag effect and how long that would take. But then they turned around and said they didn't feel like they were anywhere near slowing down on rate hikes. So I think that the important thing to take is that if they're truly data dependent, then their forecasts going out month, 2 months, 3 months, you almost have to take them with a giant grain of salt. But what I would say is, once they do get to the point where they have topped out on the level of rate hikes, that should be a very big tailwind for the equity market. So can rates continue to move higher, and how does that affect my bond holding? So inflation is ultimately going to determine the level of rates. If inflation stays high, then rates are probably going to move higher. If inflation starts to move down, we think that rates could level off a little bit and even eventually drop again. But what we would say is, I think the worst in bonds is likely behind us. That doesn't mean that there's not going to be some short-term volatility going forward, but I think the opportunities set in the bond market is pretty attractive across a good majority of sectors. And I would encourage investors not to let what's happened over the past 10 months take them away from ever investing in bonds again, because I don't think that that's the solution at this point. What are things to worry about? So the two biggest risks would be obviously a recession and then a subsequent drop in earnings. So if we got a big earnings revision down, or companies really started to guide lower, that could cause markets to revisit previous lows and increase the level of volatility that we've seen. But so far, we're a decent way through earnings season right now, and so far earnings numbers have been they've been okay. But again, they don't need to be great. They just can't be awful at this point. And then lastly, where are the opportunities? So Dan mentioned small caps. We think the valuations look pretty good there. And then, based on what the economy does, if we do see a slowing economy, that's probably ultimately going to lead the Fed to have to move rates back lower to combat that. That could be a setup where growth, the one asset class that's been hammered pretty hard this year, could begin to make a little bit of a comeback. And then treasuries, I think, would also stand to benefit from a slower growth, lower rate environment. Where on the flip side of that, if we somehow manage to avoid a recession, then things like value and more credit related bonds are probably going to benefit from that as well. And I think that that scenario remains kind of a work in progress. As the data continues to come in, so far the economy's remained pretty resilient in the face of everything that's going on, but I don't know that it would take a whole lot for that avenue to change, so to speak. So, we always like to try to offer some perspective at the end of these. And these are two magazine covers from some, very prominent publications that have come out. One a little bit further back than the other one. But if you look at the Business Week article on the left, it says the death of equities, how inflation is destroying the stock market. So this came out in, Casey, was what, 79?
Yeah, August of 1979.
Okay. So obviously this was written after a very difficult period for the market as inflation had run high. And the narrative was, okay, can't own stocks anymore because inflation is going to just eat that up. On the right, you've got a more recent article that came out in 2019 from the same publication that says, is inflation dead? So this was also during a time where we didn't have any inflation for a very long time. And people thought, well, is this going to continue indefinitely? And in both cases, these were dead wrong. The one on the right, for obvious reasons, as we're going through inflation right now. But the one on the left, if we show you a chart of $100 invested from the day that came out in the S&P 500 up to 2022, the returns are pretty staggering. So it's showing a return of about 11.5% per year off of that date. Now, the first 5, 6, 7, 8 years of that was a slower grind higher, but eventually time won out. And when we say years, not days, these bear markets make it very easy to lose time perspective. And we've tried to talk a lot about especially when we put some money back to work in mid-June, that the decision to do that was made on a 12-month time frame and not necessarily a 1 to 2 month time frame. So my guess is in the next probably year or so, because I looked for it today and I could not find it, you'll probably see a magazine article that says the death of the 60-40 portfolio. I know there's one that's going to come out. It's only a matter of time, but usually when these narratives take hold, there's probably some truth in some of them, but trends don't necessarily last forever. And it's important that we try to take a step back and realize, okay, what has happened doesn't necessarily have to continue going into the future. And it's very important to recognize that bear markets, both in equities and fixed income, usually offer the best opportunities for future returns. It's just kind of walking through that door of opportunity and being willing to take it. To kind of show an extreme situation there, we've heard a lot about the term, buying when there's blood in the streets. So here are the forward returns in the S&P after it has fallen 25% from an all-time high. This goes back to the 60s. So you've had 7 instances where we've had a decline of greater than 25% from all-time highs, which is basically what we're in right now. The S&P did cover, I believe, slightly over 25%. But what you see here is the return profiles 1 year, 3 year, 5 years, and 10 years out are very powerful. There was only really one instance where you had a negative return 1 year out. That was in 2007. But looking at these returns 3 and 5 years out, they're pretty strong. So, it never feels good to, continue to try to allocate money to the asset classes that have performed the worst. And that's just a recency bias that I think everybody has to try to overcome. But the reality is over time, it continues to remain an extremely effective way of investing. And we think that, while we could still see some short-term volatility over the next few months, we certainly think that opportunities are starting to present itself. And we're trying to take advantage of those and I would say the best way that we can, being cognizant of risk levels. So we have some questions here I want to go ahead and get to. So Dan, Casey, feel free to jump in with any of these. So the first question is a more specific question. So after our last 30-minute drop, assuming referring to the end of trading today, does the S&P get back down to 3,500? So if you've heard me speak enough, when I get specific questions like this, I usually don't even bother answering them, just because I feel like we're really just kind of guessing. And I'd rather not guess than guess and have you latch on to my answer. So can it get back to down to 3,500? Absolutely, it could. That's that short-term volatility we're talking about. The reaction at the end of today, could have been any number of things. Could have been disappointment in what the rate decision was. It could be hedges being unwound, as the VIX, or the volatility index, was actually negative today on the day there was a 2.5% sell-off, which should never happen. But it's certainly possible. But again, short-term price target like that is probably more noise than anything. Casey, Dan, do you guys want to add anything to that?
Yeah, the only thing I would add to that, Doug, is I guess from here, getting down to 3,500, that's about a 7% drop from here. And we'd be the first to admit that would probably be frustrating to experience another 7% drop. But we've been around this 3,500 territory, and the outlook at 3,500 we think is pretty good when you look out a year, 2 years, and even now, looking at again a year from 2 years from now, I think is the prospects for returns are very good. It's still trying to answer the old that question everybody wants to know is if we hit the bottom yet, and I think it's too difficult to tell. Unfortunately, I think lots going to relate, especially around the inflation data. If it's some turn soon, we start to get some hope that there's some signs that inflation is starting to really come down. then we may not see 3,500. And if it continues to last several more months, then that certainly could be in the cards. But regardless, I think whether it's 3,500 or where we are now, the prospects are pretty good when you look a year and a half, and 2 years out from now.
So next question, are the rallies that are occurring helpful to retirement portfolios versus if there weren't rallies? Or is this prolonging the pain since we need to hit a bottom to be able to head back up? It also asks, is there a Powerball tonight?
So can I jump in on this one, Doug?
Yes. Yeah. First of all, yes, there is a Powerball
Yeah.
drawing tonight, I believe.
Yeah, I think you're right. There is a Powerball tonight, and we don't. Just to let you know, we don't have a group pool in the office. Maybe it's one we should start up, but we don't have a group pool in the office. Anyway, I think what's hard about these rallies is if we look at the last two patterns of market movements, they have looked like V bottoms. So during the course of the crisis of 2020, the market went straight down only to turn around and go straight back up. And the same happened in late 2018. You didn't hit quite a 20% drop, but it was very close, and only to turn around and go straight back up. Now, from a historical standpoint, history has been that V bottoms are very rare. And the normal market pattern is what we've been experiencing, and they can be frustrating because we get these starts and stops. And so I don't know if I put it necessarily in a camp that it's better or worse. I think from an investor standpoint, it is frustrating because I think if you're in the bullish camp, you start seeing some reasons to be bearish. And if you're in the bearish camp, there are signs and things that happen sometimes that can push one out of being a bear because we get these rallies. But that's the normal part of the market. And it's why it makes investing so difficult, because it's so difficult to hit the bottom when we have these starts and stops, and only in hindsight will we know. So I know psychologically this has been one of the longer prolonged bear markets, and I think that's why it's been frustrating. But from a rally standpoint, it's common. Part of it is, as well as from a technical standpoint, it means that you're building some support. And the hope is over time that with these rallies, maybe you'll establish some lower lows and higher highs as we build and move on. But from a technical standpoint, they certainly can be beneficial. But I can appreciate from an investor standpoint that they can be very frustrating.
Yeah. So Dan, have you internally, have we seen maybe not signs of the bottom, but signs of a bottoming process?
Yeah, I mean, this last drop down to retest the June lows that we rallied out of in October could be seen as a technical confirmation of a bottom. Now, there's still a lot of work ahead. You have a lot of moving averages above that you have to cover. The downtrend is still intact, but we keep retesting it. The more you retest a trend, the weaker it gets. So things are definitely improving. I wouldn't say we're out of the woods yet, but things are looking a lot better than they were back in June.
Good. And then the last question here that I'm going to try to combine two together. So what are your thoughts about the outlook for oil over the next year or so? This person is expecting all-time highs and wants to know, does this sound probable given the landscape? So I think energy is going to be a sector that's probably going to continue to do well, simply because, and again, trying to make this sound as apolitical as possible. There's certainly been a push over the past 5 years to transition the energy policy, not just in the US, but globally, to a more green or clean energy platform. And throughout that process, it's not only been investing in newer technologies, but also trying to limit the output from old technologies. So I think maybe there was a little bit of over optimism in the ability to flip that switch overnight. And what happened was with the situation that we saw in Ukraine, and then the global supply chains being shut down, that We still need the ability to produce fossil fuels to meet the demand that is still being produced globally. And when that is affected, then you have a supply and demand imbalance. So I think that supply and demand imbalance is going to remain in place for quite some time. It's not simply the oil companies being able to stick a stick in the ground and all of a sudden you've got oil and then you can refine it, you've got gas. The process is a little bit more involved in that. So I think, as long as you've got supply issues, and Russia was a large producer of oil and gas in the marketplace, and even if the war were to end today, my guess is the sanctions would not be lifted. So that is going to be an ongoing issue. I think without significant demand destruction, you will probably see elevated oil going forward. Now, are you going to see $200-$300 barrel oil? I don't know about that, but oil doesn't need to be at extremely high levels for energy to still make sense as an investment. So we think, given the outlook, that's probably a sector that's going to continue to perform well outside of a significant recession. So I think that's all the questions that we have for today, and we're right up against time here. So Casey, if you'd like to take us out.
Yeah, thank you very much for being with us on our webinar today. And we appreciate the trust and confidence that you've placed in HCM. These are challenging times, and this market downturn has been one of the longer downturns in more than a decade. So please don't hesitate to reach out if you'd like to discuss your individual plan. We're glad to help. If there's a family member or friend we can help, please don't hesitate to reach out to provide an introduction. We would be honored. Have a great night.